Phil Tily, Managing Director of IPD's UK business. Thanks very much for talking to Bloomberg today. Could you just start off telling us how things are looking at the moment in the UK?
Yeah, in terms of the commercial property market, performance levels have kind of continued at a fairly pedestrian rate off the back of what was a kind of declining market last year. So property values overall are still in decline, but at a reduced rate. Most of that decline has come from a kind of fundamental repricing across the property market as a whole in the wake of an overall economic slowdown, and rental value positions have been pretty much static, and it's the failure of the overall economy to revive itself that's led to that reversal in investor sentiment, and we've seen declining values now for 5 quarters in succession. But the positive is that the levels of decline have eased off, and actually our monthly numbers, which were released a couple of hour and a half ago at 3 o'clock today, showed that decline in values is now at a pretty much negligible level.
What's happened in London since the financial crisis?
Yeah, so the market is incredibly polarised, possibly more so than any point that we've been reporting on the property performance over, which is a 30-year history. So everything was pretty much kind of hit in a similar kind of level in the wake of the overall global financial crisis. But London's bounced back a lot stronger in effectively what's been a risk-averse investment climate. And so if you look at performance levels for last year, 2012, London was the only part of the market which was now delivering a level of capital improvement and investment returns in the order of almost double-digit territory. And that advantage has been sustained through the earlier part of this year. Now, part of that has been driven by overseas investment demand, looking for a safe place to invest their capital, stability of the income streams they're getting off the London commercial real estate market. But the other benefit, the other upside, is that we're starting to see improvements in terms of support coming through from rental value performance. So the fundamental drivers of the occupier market providing an improvement in rental value growth. And there's obviously been a tail off in terms of levels of demand from the financial service sector, but that's been tempered by a comparatively low pipeline. So kind of limited supply of prime office space has allowed those rental values to improve. There's obviously increased traction from the TNT sectors as well, and London proving an increased traction for kind of a number of the major European headquarters to establish themselves. So very much kind of the powerhouse of the property scene still.
So we're not seeing a similar kind of picture outside London, I'm taking it?
No, and outside the London market, it's very much the reverse, in that we've seen kind of declines in values continuing into the first quarter of this year. And that's been a theme throughout the course of the previous 18 months. And the further you kind of progress from the southeast, the more subdued those performance levels become. So the values are still very much in decline outside the southeast. Although closer inspection of our numbers shows that we're starting to see a degree of stability. So I think of the 80 billion of assets that we're measuring outside the southeast in the last quarter, so the first 3 months of this year, 30 billion of those property values remain static or started to improve slightly.
So are more of your clients being tempted by the regions then?
And that's the point. I mean, the flip side of the interest in central London is it's become quite an expensive marketplace. So returns on income around below the kind of 4.5% mark, which is still competitive given the bond yield positions. But you're opening up a significant price point arbitrage now between London and the regions. So with income returns in excess of 8 up to 10 percentage points, and given that values are now starting to stabilise, investors are tempted to edge up that risk curve, possibly braving the near-term economic fundamentals in terms of longer-term reward. And it's kind of reworking assets in those regional markets, lease-free gears, reletting, that's enabling them to start to maximise some performance levels.
And will that help capital values of properties, commercial property in the regions then?
Yeah, and that's what we're seeing. So if an investor reworks an asset with a degree of expenditure or secures a new letting, you see some upside in terms of capital performance. But there's also a sting in the tail as well, in that given it's a risk-averse market, it's all about tenant security, and as some of the leases near expiry, we see fairly hefty write-downs on some of the property valuations. So the asset management play works two ways. You're defending your position in order to kind of stabilise your performance position, kind of reworking leases which are nearing expiry, but reworking those leases on some of the better quality assets is enabling the positions to be maximised. So we're starting to see levels of capital growth come off the back of asset management plays.
Thank you very much.
Pleasure.